Imagine you're walking down the street, right? And there are two car dealerships directly across from each other.
Right, okay, I'm picturing it.
And they're selling the exact same sports car. I mean, same make, same model, same engine, literally the same fresh off the lot smell.
Right, identical cars.
Yeah, completely identical. But dealership A is charging $100,000 and dealership B is charging $150,000.
Well, I mean, any sensible person would just cross the street and save 50 grand, right?
Exactly. Why on earth would people literally line up around the block to buy the car at the more expensive lot?
It sounds totally irrational. Like, that just doesn't happen in the physical world.
It doesn't. But today, we are diving into a situation where this exact scenario is playing out right now, not with cars, but with billions of dollars in the global stock market.
Oh, yeah, it's wild.
We are looking at SK Hynix, which is, arguably one of the most critical tech companies on the planet today. Yeah. And we've got a massive stack of sources for this deep dive. We're talking banking notices from Citi, EPF prospectuses, international financial news, and market share research from Counterpoint.
Lots of heavy reading for this one.
Yeah, lots of data. But our mission today is to figure out why a massive real-time financial anomaly is happening with this specific stock.
Because right now, investors in the U.S. are paying up to a 51% premium to buy American Depository Receipts, or ADRs, of SK Hynix.
Wait, 51%?
Yeah, up to 51% more compared to the exact same company shares trading over in South Korea.
A 51% markup for the exact same ownership.
Yep. What's fascinating here is that this isn't just some weird computer glitch.
Right.
It's actually a perfect storm. You have the unstoppable demand for artificial intelligence violently colliding with, well, physical and structural barriers in global finance.
It really is like the financial equivalent of a traffic jam on a bridge, right? Where the toll booth is suddenly charging a 50% surge fee and people are just gladly swiping their credit cards anyway.
Gladly paying it, yeah.
But before we get into the whole demand side of this, we really need to establish how a price gap this massive can even exist in the first place.
We should probably start with the basics of the offering.
Good call. So SK Hynix recently raised $26.5 billion through a U.S. ADR offering, right?
Right. And for those who might not deal with international stocks daily, an ADR is basically a certificate issued by a U.S. bank, and it represents shares in a foreign stock.
Okay.
So it allows American investors to buy overseas companies right on U.S. exchanges. You don't have to deal with, foreign currencies or time zone differences.
Or setting up some complicated foreign brokerage account.
Exactly.
Yeah.
But to actually create one, a custodian bank in the home country, so South Korea in this case literally has to take the local shares, lock them in a vault, and then a U.S. bank issues certificates backed by those vaulted shares.
Got it. And for this specific SK Hynix offering, the ratio is 1 ADR representing 10 ordinary Korean shares.
Correct. 10 to 1.
So when this ADR launched last week, the premium, that extra cost you pay for the convenience of buying it in the U.S., it started at a pretty standard 3%.
Which is totally normal.
Right. But then, in just 3 trading days, it surged past 50%.
It just exploded.
Yeah. It has settled a bit since then, hanging around a 25 to 27% markup. But the craziest part of the data for me is that while the U.S. version was skyrocketing, the local Korean shares actually dropped over 12% leading up to the ADR listing.
Yeah, so you've got the U.S. side bidding the price up super aggressively, while the Korean side is selling off.
Which just stretches that price gap even wider.
Exactly.
But wait a minute, I'm looking at this 50% spread and something just isn't adding up for me.
What do you mean?
Well, if the gap is that massive, why aren't the high-frequency trading firms just eating this up? I mean, isn't that how basic arbitrage works?
You think so, yeah.
Shouldn't Wall Street supercomputers just be instantly buying the cheap Korean shares and selling the expensive U.S. ones to close that gap?
Under normal circumstances, they absolutely would. I mean, an algorithmic trader spots a tiny fraction of a percent difference. They buy the cheap asset in Seoul, short the expensive one in New York.
Pocket the risk-free profit.
Right, and that brings the two prices back to parity in milliseconds.
Right.
But here, the arbitrage machine has hit a physical roadblock.
A physical roadblock in a completely digital market.
Yeah. If you look at the official depository receipt notice from Citi, they're the bank managing these specific ADRs. There is this critical administrative line in the fine print.
Okay, what did it say?
It says that the books are closed for issuance and cancellation until the close of business on July 29, 2026.
Oh, wow. So the bridge between the two markets is just temporarily drawn up.
You literally cannot convert the shares right now.
Period.
Period.
Oh.
The newly issued common shares are not officially transferable in Korea until they get listed on the Korea Exchange on July 29.
So Wall Street algo can look at that massive 50% spread all day long.
But they can't actually execute the trade. They can't buy the Korean share, hand it to the custodian bank and say, hey, lock this in the vault and give me an ADR so I can sell it in New York.
Because the bank's receiving window is just bolted shut.
Exactly.
So it really is like those two car dealerships, but there's a giant uncrossable chasm in the middle of the street. And the construction crew is like, yeah, we don't open the bridge until July 29th.
That's a great way to put it. Because the bridge is out, the two markets are operating completely independently of one another. They're driven entirely by their own local supply and demand.
Okay, but if Wall Street knows the bridge is completely out until July 29th, why not just sit on their cash and wait?
That's the million-dollar question.
Right. Paying a massive surcharge today when the road literally opens in 2 weeks seems like a terrible trade. Why are U.S. investors so desperate to get their hands on SK Hynix right this second?
Well, to understand that desperation, you really have to look at what SK Hynix actually manufactures and why it is the most critical hardware bottleneck in the world right now. The market research data we have from Counterpoint Research paints a pretty staggering picture.
Let's hear it.
SK Hynix currently holds a dominant 58% market share in high-bandwidth memory chips, specifically the HBM3E generation.
Okay, we need to unpack that because high bandwidth memory, or HBM, is basically the absolute lifeblood of artificial intelligence.
Completely.
Like, you cannot train or run these advanced AI models without these specific chips.
No, you can't. When companies announce they're buying, tens of thousands of NVIDIA AI processors, those processors require HBM to actually function.
Right, they go hand in hand.
And that 3E designation is really important here. It stands for the 5th generation, the extended version.
So these aren't just your standard memory chips that go in a cheap laptop.
Not at all. They are incredibly complex. They're stacked vertically, kind of like a high-rise building, and they're connected with these microscopic wires straight through the silicon. And the manufacturing yield rates for these are notoriously difficult to master. But SK Hynix figured it out first.
Which makes them the initial and undisputed primary supplier to NVIDIA.
Exactly.
Here's where it gets really interesting to me. It's almost like a Formula One race, right? NVIDIA is the championship team, and they're winning every single race right now.
Sure.
But their cars can only run on one specific brand of high-performance tires. So if you want to bet on that F1 team winning, you practically have to own the tire company, too.
That is a perfect analogy. SK Hynix isn't the only tire manufacturer, of course. Samsung and Micron are in the race, too.
Right.
But according to the Counterpoint data, Samsung and Micron both only hold about a 21% market share each.
Well, SK Hynix is sitting at 58%.
Exactly. Now, that is down slightly from their 69% share last year, but, they are still the overwhelming leader.
And the other piece of this puzzle is the valuation. SK Hynix is, just fundamentally speaking, on sale.
Oh, it is deeply undervalued compared to its peers. Just look at their 12-month forward price-earnings ratio, or PE ratio, which is what investors use to gauge value.
What are they sitting at?
SK Hynix is at only 6.9 times future earnings. Compare that to Micron, their U.S. rival, which is trading at an 11 times multiple.
That's huge. You have a company with a near monopoly on the most important hardware in the AI revolution, and it's trading for almost half the valuation of its competitor.
Yeah, so U.S. institutions look at this and they see a generational wealth opportunity. They see foreign investors heavily playing this specific strategy called SK Hynix long, Samsung short.
Betting that Hynix keeps winning the memory race and Samsung keeps lagging.
Precisely. And this strategy has been so aggressive lately that it's driven SK Hynix's market cap to nearly 89% of Samsung's, if you exclude preferred stocks.
So U.S. investors desperately want this stock, but they do not want the headache of Korean market hours.
Or the currency exchange risks.
Right, or the regulatory hurdles of buying local Seoul shares. They want the convenience of the U.S. ADR, but the supply of the ADR is tiny right now, and the bridge is closed.
So that 50% premium, it isn't a reflection of the company's actual fundamental value at all. It's really just a reflection of sheer fear of missing out. It's desperation for access.
But if these massive U.S. funds are locked out of the direct trade by closed books, they aren't just going to sit on their hands, right?
No.
They're going to force that capital through whatever back door or window is open. So what do those workarounds actually look like?
Well, this is where the plumbing of the financial system gets really messy. Since investors refuse to pay a 50% markup on the ADR, but they still need that AI exposure, they turn to proxy plays.
Meaning they find something else to buy that just happens to have SK Hynix inside of it.
Exactly. And the biggest target became the iShares MSCI South Korea ETF, ticker symbol EWY.
Oh, I saw this in the notes. This is wild.
Yeah, in a single day, investors poured a record $1.1 billion into this one ETF.
$1.1 billion in one day, just trying to get to SK Hynix.
Yep. It ballooned the fund's total assets to $23 billion, which is a 180% increase just this year alone.
That is staggering.
And they did this because EWY holds roughly 25% of its portfolio in SK Hynix. So by buying the ETF, U.S. investors get backdoor exposure to the cheaper local Korean shares without actually having to trade in the Korean market.
Okay, but hold on. If SK Hynix is on this incredible run, right, and the rest of the Korean market is relatively flat, doesn't that massive growth start warping the ETF's own portfolio?
It absolutely does. It creates a complete regulatory nightmare.
Oh, so?
Well, there are strict U.S. fund management rules that cap how much of a single stock a fund can hold. Generally, a single stock cannot exceed 25% of a fund's total assets.
Ah, okay, so if SK Hynix surges in value, its weight in the ETF naturally pushes past that 25% legal limit.
Right. And when that happens, the ETF is forced into what's called mechanical selling.
Mechanical selling.
Yeah, the fund managers literally have no choice. They are legally mandated to sell off shares of SK Hynix just to get the weighting back under that 25% threshold.
That is deeply ironic. People are pouring billions into this ETF specifically because they want to own SK Hynix.
Yes.
But by doing so, they're making the stock's footprint so big that the ETF is legally forced to sell it, which accidentally suppresses the price of the exact asset they are trying to bid up.
It is the definition of a structural trap.
Yeah.
And, it really highlights how blunt these proxy instruments can be.
So what does this all mean for the average retail investor? If I buy a South Korea ETF just to get SK Hynix, aren't I also just buying a bunch of other companies I might not want?
You absolutely are. You're inherently buying a basket of other things like Korean banks or heavy industry. It is a really blunt instrument, highly inefficient, but it just proves the extreme lengths institutions will go to for that AI hardware exposure.
Is there any relief in sight for that specific ETF issue?
There is a silver lining. Once the ADR is fully listed and trading normally, it will eventually allow SK Hynix to be included in broader U.S. sector funds.
Like what?
Like the massive SOXX semiconductor ETF, which manages over $43 billion.
Okay, I know that one.
Because the semiconductor ETFs hold a ton of other massive tech companies, SK Hynix wouldn't bump up against that 25% cap nearly as easily, which essentially eliminates that whole mechanical selling problem.
Okay, that makes sense. But until that happens, traders are clearly looking for even more tactical, surgical tools to play this chaos. I saw in the sources that some traders are turning to a highly specialized ETF called the Leveraged Shares 1X Short SK Hynix Daily ETF, ticker SKHZ.
Right, SKHV.
Now, a short ETF means this is for people betting the price is going to drop, right?
Or more accurately in this case, it's for institutions hedging their bets against the extreme volatility of this premium.
Okay, explain that.
Well, if an institution wants to short a foreign stock the traditional way, it is an operational nightmare. You have to locate the foreign shares to borrow, pay really high borrow fees, and post collateral.
Sounds expensive.
It is. And crucially, you face the risk of margin calls. If you short a stock and it goes to the moon, your losses are theoretically infinite. Your broker will call you and demand more cash to cover the position.
But this short ETF circumvents that risk.
Exactly. With an inverse ETF like SKHZ, which by the way charges a 0.75% expense ratio, the absolute most you can lose is your initial investment. You just buy the ETF like a normal stock, and it handles all the shorting internally. You can't go into debt to your broker.
We do have to talk about the massive warning label on these types of daily and inverse ETFs, though. The concept of volatility decay.
Yes, this is absolutely vital for you to understand if you ever look at these financial products.
Because it's not a set it and forget it thing.
Not at all. SKHZ is a daily short ETF. It is designed to deliver the exact inverse of SK Hynix's return for one single day. The underlying math resets every single night.
Let's walk through the math on that just to show why it's so dangerous to hold long term.
Okay, imagine the underlying stock starts at $100. And let's say it drops 10% on Monday. Now it's at $90.
Okay, simple enough.
The short ETF perfectly mirrors that, going up 10%. So it goes from $100 to $110. Great.
Great.
But on Tuesday, the underlying stock bounces back 11.1%, returning exactly to $100. So the stock is back to where it started, totally flat for the week.
But the ETF resets.
Right. Look at the short ETF. It started Tuesday at $110. It has to deliver the inverse of that 11.1% gain. So it loses 11.1%.
Oh, I see where this is going.
Yeah, an 11.1% loss on $110 brings the ETF down to $97.79.
So if I put $1,000 into this expecting a nice, safe hedge, and the stock essentially goes nowhere for a week, just bouncing up and down, I'm actually just bleeding cash every single day.
That is volatility decay. In choppy markets where the price is swinging wildly up and down, that daily compounding physically erodes the value of the ETF. Tools like SKHY are surgical instruments for daily, short-term trades.
Definitely not long-term holdings.
No, absolutely not.
So we really have a pressure cooker building here. We have a 25% premium on the ADR. We have billions flooding into proxy ETFs, causing accidental mechanical selling.
Yep.
We have traders using daily inverse ETFs to hedge the chaos while fighting off volatility decay. And all of this tension is building toward a single date on the calendar.
July 29, 2026.
Right. What exactly happens on that day?
July 29th is the massive release valve. 3 huge things happen basically simultaneously. First, SK Hynix releases its Q2 earnings, which injects fresh data into the market about their AI chip dominance.
Okay, fundamental news.
Second, the new shares officially list on the Korea exchange. And third, most importantly, the City ADR books finally open for conversion.
The bridge finally lowers.
Exactly. Currently, ADRs only make up about 2.5% of the total outstanding shares. But on July 29th, an additional 22.5% of shares become eligible for conversion.
That is a huge jump. Suddenly, there is a massive flood of potential supply.
Exactly.
Okay, so July 29th, the magic date, 9:30 a.m., the gates open. Does this mean the 25% premium instantly vanishes? Like, do the high-frequency algorithms finally get to cross the bridge and crush that gap down to zero?
If we connect this to the bigger picture, the gap will certainly narrow, but it probably won't instantly vanish. And honestly, it might never reach perfect parity.
Why not? The bridge is open.
Because the structural trap is completely asymmetrical.
Meaning the rules aren't the same in both directions.
Exactly. According to the depository rules, converting ADRs back into local Korean shares is unlimited. You can convert as many as you want.
Okay.
But converting local Korean shares into ADRs, which is the exact action you need to take to sell them in the U.S. and close this premium gap, is strictly capped.
Wait, there's a limit?
Yes. The issuer sets a hard upper limit on total ADR issuance. Once that limit is full, you cannot convert any more shares. So the arbitrage trade just hits a concrete ceiling.
It's like having a 4-lane highway letting people out of the city, but only a tiny single-lane dirt road letting people in.
That's exactly it.
There just isn't enough capacity for the algorithms to apply the necessary pressure to equalize the price.
And to complicate the plumbing even further, everyday retail investors are completely locked out of this conversion process anyway.
How so? If I own local shares in Seoul, why can't I just convert them myself?
Because in the Foreign Exchange Transactions Act in Korea, and just a mountain of red tape, to convert a local share to an ADR, an individual investor can't just log on to their mobile app or home trading system and click convert.
It's not just a button click.
No, it requires real name verification for cross-border securities, manual physical paperwork, and massive custodian fees.
Oh, wow.
The friction is so high that, practically speaking, only massive institutional investors have the infrastructure and capital to execute these conversions.
So it's a completely unequal playing field. The institutions get to play the arbitrage game up to the cap, and retail investors are just stuck watching from the sidelines.
Yeah. And because of these frictions, the issuance caps, the regulatory red tape, the retail lockout, the premium will likely be incredibly stubborn. We actually have a clear historical precedent for this.
Oh, really? Which one?
Look at TSMC, the Taiwanese semiconductor giant, another massive chip maker, totally critical to AI.
They've dealt with this exact same dynamic.
They have. TSMC's ADRs have maintained an average premium of around 19.1% since 2024.
19.1%.
Yeah.
For over 2 years.
Yep. And that persistent gap exists because of these exact same structural frictions and retail lockouts in Taiwan. So the gap on SK Hynix will narrow from 25% once the July 29th conversions start, but the notorious Korea discount, combined with these institutional roadblocks, will likely prevent perfect parity.
So we are probably going to see a premium persist for a very long time.
Most likely, yes.
Wow. Okay, so to bring this all together, we started with a massive 50% price anomaly on one of the world's most critical AI hardware companies. We mapped how SK Hynix's sheer dominance in making HBM3E chips created this unprecedented demand among U.S. investors.
Right.
And then that demand just slammed headfirst into the closed books of the ADR depository, breaking the arbitrage machine and forcing the price sky high.
The perfect storm.
And we saw how that desperation spilled over, causing record billions to flow into proxy ETFs, triggering mechanical selling, and creating a specialized market for daily inverse hedging tools.
A lot of dominoes falling.
Yeah, so many. And the ultimate takeaway for you, listening to this right now, is that the stock market isn't just some pure reflection of finding a good company that makes money. It is deeply reliant on the physical plumbing of the financial system.
It really is all about the plumbing.
Sometimes the price you see on your screen isn't dictated by pure supply and demand. It is dictated by legal limits, closed bank books, and conversion caps.
And, that actually raises an important question to leave you with today.
What's that?
Well, we tend to view these structural barriers like the closed books, the one-way conversion limits, the fact that retail investors are totally locked out by red tape. We view them as glitches.
Right, inefficiencies in a globalized market that ought to be fixed so capital can just flow freely.
Exactly. But what if they are bugs?
What do you mean?
Consider the possibility that these frictions are actually intentional features. What if these barriers are quietly and deliberately maintained by local regulators as a defense mechanism?
A defense mechanism against what?
Against overwhelming, violent waves of foreign capital instantly flooding in or rushing out and completely destabilizing their domestic markets.
Wow. So the bridge isn't just temporarily closed for maintenance. Maybe local authorities installed the toll booth and the gate precisely to control the traffic.
It really makes you rethink the entire architecture of global trading, doesn't it?
It really does. You think you are just crossing the street to buy a car, but it turns out governments and custodian banks actually control the roads.
We will have to see what happens when the light finally turns green on July 29th.
Absolutely. Thanks for diving deep with us.